back to Watch Your Assets, where we've got your money on our minds. I'm your host, Stephanie Bracken, and today we are talking about one of the most underrated parts of your financial plan, your insurance coverage. Now, this is going to be a two-part series because there is a lot to talk about with insurance. So we're going to scratch the surface on some definitions, some terms that circle around the insurance world, and then we're going to talk about some types of coverages, and then in part two, I'm going to really get into more coverages. So today I'm going to cover health insurance, disability insurance, and long-term care. And then in the next episode, I'm going to do life insurance, property casualty, and maybe more. We'll see. But this is not the most exciting topic in the world, but you're going to want to stick with me because insurance is the safety net that helps to protect everything else that you're working towards. Whether you're protecting your health, your income, your family, your legacy, or your home, your properties, anything like that, insurance is how you protect those things in case of an emergency. It's what helps make you whole again after a catastrophic loss. Insurance is the process of transferring or sharing the responsibility of risk with an insurance company. So you say to the insurance company, hey, I'm okay retaining X amount of dollars worth of risk on my homeowner's insurance, for example, and that's going to come in the form of your deductible. And I want you as the insurance company to help me with the rest of that, again, in the event of a loss. So like I said, we're going to talk about health insurance today, we're going to talk about disability, and we're going to talk about long-term care insurance. But let's first cover some definitions because, again, there are a lot of buzzwords that come with insurance coverage, and I want to just make sure that you fully understand what each part of different types of insurance is so that you can understand your coverages, your costs, and all of the other things that are going to come with your insurance. So number one, we're going to talk about premiums a lot. So premiums are what you pay monthly to your insurance company to have the insurance coverage. This typically comes out of your paycheck or is paid for by your employer if we're talking about health insurance. If it's premiums for car insurance, disability insurance, private life insurance policies, things like that, those are going to come out of pocket for you or to you. Maybe, or whoever is paying and however you're paying, this is the cost to keep your insurance valid, right? So premiums don't get you much aside from having the policy itself, except in the case of life insurance, which again, I'm going to cover in the next episode. But premiums, again, are what you pay each month to keep the current level of coverage that you have. Then let's talk about deductibles because that's a separate thing. So deductibles are what you pay out of pocket for covered expenses before your insurance benefit kicks in. I think one of the ones that people are probably most familiar with is your car insurance. So when you get into a car accident, your premiums, again, aren't doing anything for you when you get into an accident, but of course they're what keeps the coverage around. Your deductible is what you will pay out of pocket before your car insurance will start to pay for any damages or losses to your vehicle or to someone else's. So if you have a $500 deductible on your car insurance, you're going to pay that $500 and then whatever else is not covered with that $500 deductible. If you need, your fender replaced, if you need some body work done on your car, anything above $500 is going to be covered by your insurance company. But it's not just car insurance. It's any type of insurance really has a deductible that's going to come with it to help keep the costs low typically. So if you have a high deductible, that probably means you have lower premiums, and vice versa. If you have high premiums, you might have a lower deductible because you are telling the insurance company, I only want to pay $250 towards my deductible, and I'm going to ask you, the insurance company, to pay for more of my expenses with certain accidents. Therefore, the insurance company says, well, the trade-off there is your premiums are going to then be higher because you are not taking on as much of the risk sharing as we are. So to combat that, or as a compromise, you typically pay higher premiums because you have a low deductible, and vice versa. Because you have a high deductible, you'll have lower premiums because you're retaining more of that risk versus the insurance company. So if you have a $2,000 deductible and you only your damages are only $1,500, the insurance company didn't have to pay anything. So they're okay doing that because you're shelling out more of the money. So those are two terms that are typically synonymous with most types of insurance. Again, that's going to be your car insurance, your homeowner's insurance, your health insurance. Life insurance typically doesn't have deductibles because you're passing away, and so there's no risk for you to assume with a life insurance policy. So you have premiums that you pay on life insurance because you need the policy to stay around, but there's no deductibles on life insurance. But most other types of insurance have deductibles on them. Then let's talk about some terms that are specific to health insurance. So the first one I'm going to talk about is going to be what's called your max out of pocket. So that's sometimes called a MOOP. So your MOOP is the max that you will have to spend on your own each year before your insurance will pay for 100% of the costs. All health insurance plans are required to have some level of a MOOP because they don't want you to be in financial ruin over your medical bills. So this helps you or prevents you from paying hundreds of thousands of dollars for medical expenses if you have any large medical bills in any one given year. Now, your MOOP resets each year. So if your MOOP is $5,000 and you've met your deductible and you've also spent your maximum out of pocket for the year if you had large medical bills, at the end of the year, when you roll over to the next year, that MOOP is going to reset itself, and you have to do the same thing over again. If you have more claims that you will file, your MOOP doesn't just stack on top of each other, so you have to start all over again. Your deductibles are the same way. So if you meet your deductible in 1 year, the next year it resets. So just keep that in mind as well, that these are not cumulative. You have to keep resetting those each year. Well, you don't. The insurance company does. Then we've got something else called copays. Copays, again, this is for health insurance typically. This is a fixed dollar amount that you as the patient will pay up front for medical services as part of your coverage. This is part of the cost sharing that you are doing with your health insurance provider. Copays can vary depend on the type of service that's rendered. So, for example, with my insurance policy, I think I have a $50 copay that I owe if I go to MedExpress. But if I go for preventative care, there might not be any copay that I will pay. But it is specific to everybody's plan, so keep that in mind that this is not your sometimes you might not have copays at all. Sometimes you have high copays, sometimes you have intermediate copays, sometimes your copay is standard across the board for any service. So it just depends on what your plan offers and what that cost sharing piece of your insurance is going to be. Even if you meet your deductible for the year, you might still owe copays on whatever services your plan is requiring. So keep that in mind as well, that even if you meet your deductible and you go to MedExpress, you still may owe a copay. Then there's something else called coinsurance. So this is my last definition for this segment. Coinsurance is the percentage of costs that an insured person will pay for covered expenses after meeting their deductible up to their MOOP, right? So an example of this, a very common one, is an 80-20 coinsurance plan, where once you meet your deductible, the plan will pay for 80% of your covered costs while you pay 20%. And again, this kicks in after your deductible is met. So they may not, I said before that your insurance may pay for 100%, but if you have a coinsurance provision, you still may owe some piece of that. It might not be 100% coverage. So now that we've covered some basic definitions here, let's talk about some different types of insurance and really get into the nitty-gritty of different types of coverage that you may or may not want to have as part of your plan. And as I get into these, just know that all of these may not apply to every single person. So just keep that in mind, that I'm going to cover a whole bunch of different types of insurance in this segment and my part 2. But just know that this is going to be specific to your situation. So that's something that we will evaluate when we look at your financial plan, is to make sure that you are covered against the risks that you take on specifically. Because, for example, somebody who likes to skydive as a hobby might need higher health insurance, they might need more life insurance coverage, they might need more disability insurance than someone who works a white-collar job. So it just depends on your lifestyle and on your situation. So just keep that in mind. As I say in every episode, these are not blanket recommendations that I am making. So let's talk about health insurance first, because I think this is the one that most people come into contact with whenever they first start working, right? Because a lot of the times your employer may offer health insurance coverage as part of your overall benefits package. Or if you don't have it through your employer, it might be through a government program, or maybe you have to buy it on the marketplace, or maybe you use your spouse's. It just depends. Maybe you use CHIP for children, and I think CHIP might be specific to Pennsylvania. I'm not 100% sure on that, but there are different insurance programs that vary state by state that can benefit different demographics of individuals. But healthcare costs in the U.S., let's just call it how it is, they are no joke. A single trip to the ER could cost you thousands of dollars. And without health insurance, and this is where my piece of it really comes in with financial planning, is without health insurance, a medical emergency can derail your savings. It can derail your retirement date. You can start to rack up debt over this. And a lot of the times when we're talking about bankruptcies, there's a large percentage of bankruptcy cases that people declared bankruptcy because of extreme medical bills. There's a study that was performed by the Kaiser Family Foundation that says over 60% of bankruptcies in the U.S. involve medical bills to some degree. Now, when we're talking about health insurance costs, if it's group coverage, if your employer offers this coverage for you as part of your benefits package, sometimes you get a say in what type of plan you select. So sometimes you might get a gold, silver, bronze option for a PPO plan or something to that extent, where you get to choose your deductibles, your premiums that best fit your lifestyle. Other times, depending on where you work, maybe the size of the organization may limit the fact that you can't select different plans. So sometimes if you want to be on your company's health insurance, you just might get one standard plan that is the same for all employees. So that's going to really just depend on your employer and what they offer you. But typically, they will also do a cost sharing with you where maybe they pay for half the premiums, you pay half the premiums, and those typically come right out of your paycheck, so you don't really miss them. They're one of the things that comes out of your paycheck before that money hits your bank account. So there might be a cost sharing that happens, and again, you can probably have a standalone plan for your dental and your vision. Those typically come separate from your actual medical expense or your medical insurance coverage with group insurance. And those might be an additional cost on top of your medical premiums. But typically, vision and dental are pretty affordable. They're maybe $5, $10 a paycheck. So they're not super cost prohibitive to be in them. And they offer typically things like preventative care. So if you have dental coverage, those may allow for 2 cleanings per year with maybe x-rays as well. And then vision may offer 1 eye exam per year that is covered. Now, they'll probably offer some benefit towards contacts or glasses for those of us who are unfortunate enough to have terrible vision, who need contacts or glasses. That vision coverage is there will probably be some benefit that you'll be able to put towards your glasses or your contacts. You typically can't do both as I am very much aware. I choose the contacts most times, but if you are a glasses wearer, obviously you can put that money towards that as well, and that'll go towards your frames, your lenses, all of that good stuff. And then sometimes the health insurance costs can also, for medical, can also be for family members as well. So if you're married, sometimes your employer will allow for your spouse and your children to be on your insurance as well. It just may affect your premiums versus somebody who is single. There are other group benefits that employers may offer as part, again, of your benefits package. One of those things that sometimes employers will offer is group life insurance coverage, where they will offer either a set dollar amount. Sometimes it's $50,000 of coverage that they will offer. Sometimes it's a multiplier of your salary. Sometimes it's 1, 2, 3, or however many multiples of your salary as a death benefit if you want to keep that coverage. And typically, the more coverage that you request, the more your premiums are going to be. Again, that will come right out of your paycheck if your employer is paying for it or is splitting the cost. And that coverage is usually what is called a term life insurance policy. So it is typically not portable. Now, there are some exceptions where you have the option, if you retire or if you leave, to carry that coverage with you, where you kind of break away from your employer's plan, but still keep the coverage at whatever company was offering your life insurance. And you can start to pay the premiums out of your own bank account instead of it coming out of your paycheck. But that just depends on the plan as well. But again, typically, that group life insurance is going to be either a set dollar amount that you can select or a multiple of your salary. And some of them, just for federal employees, for an example, you also have the ability under your group life insurance to add on different coverages for your spouse and for children that increases your death benefit depending on how many children you have, depending on your spouse, if you want them to keep that extra coverage. So they allow for additional coverages that other employers don't always offer. If you get above a certain dollar amount of coverage for group insurance, group life insurance, you may have to go through what's called underwriting, and I'll get into this more in the life insurance segment, but you may have to go through underwriting where the insurance company wants to make sure that you are not a huge risk to them. They want to ensure that you're in good health. Typically, if you're a smoker or you're a tobacco user, you might have extra premiums for the fact that you use nicotine products, but they want to make sure that you are what they deem to be an insurable person. So, and group coverage, I don't know that you'll ever totally be denied for your coverage, but your premiums are just going to be really, really high. If you want a multiple of your salary or if you want a really high level of life insurance on your group policy, you might just see higher premiums as a tobacco user. And there's a certain break point where you don't need underwriting too. So, if your employer says, hey, if you get under $100,000 worth of coverage, you won't need to go through underwriting. You can always select that option because it's not that much more expensive than, again, that $50,000 that's typically standard. You can get that extra coverage but not need to go through underwriting. But if you're healthy and you don't go to the doctor too much, you don't have a lot of underlying conditions, you can typically get that group life insurance policy for not that much extra money, and it won't be a big deal to go through underwriting. The other piece that a lot of employers offer is things what are called ancillary coverages. So this is going to be things like covering for cancer, critical illness, accidental death and dismemberment. These are additional insurance policies that you can carry as part of your group benefits. They're typically optional. You don't necessarily have to enroll in these, but they're extra coverages should you, God forbid, something happen to you. You'll have extra coverage for some of those extra medical bills that may come about that your typical medical policy may not cover. So those can be good things to have. But again, it just depends on your willingness to pay the premiums, and maybe family history, your lifestyle, things like that are going to come into play on whether or not you want to carry those extra coverages. One of the other big ones that comes into play with with health insurance is the fact that after retirement, and I talked about this in my retirement planning podcast, after retirement, health insurance costs are really going to come into play, because if you were used to having a group medical policy, when you retire, typically that coverage gets shut off. Again, I'm back to federal employees. Typically, you are able to keep your group health insurance coverage after retirement, but most employers kick you out of the plan at some point in time. So you're going to have to go to the marketplace to find insurance. So in Pennsylvania, that is called Penny. If you're under 65, that is where you will shop the marketplace, find a probably comparable plan to what you had before you retired, and you will start to pay those premiums yourself. You typically can keep your doctors. Raquel, our director of insurance, can help you find a plan where you can keep your same doctors, you can keep your same prescriptions, still be in network, get you a plan that's comparable on the coverage side of things with reasonable premiums, because the premiums on post-retiree health insurance can be really, really expensive. And I think, again, I said this in my retirement planning podcast, that is one of the reasons why people don't retire, is because they don't want to lose their health insurance coverage and incur an extra $1,000, $1,500 a month premium bill for their health insurance. So that's going to be a huge consideration whenever you are getting ready to retire, is what are you going to do about your health insurance? And we can certainly help you navigate that. So that's not a scare tactic, but it's just something that you want to be aware of when you're doing or thinking about your retirement plan. When you hit 65, of course, is whenever you're going to be able to enroll in Medicare. And Medicare premiums are typically a little more cost effective than your Penny or your other marketplace insurance coverages. So Part B premiums for this year, I think, are around $180, and they are reevaluated every single year, usually adjusted for inflation, but it depends on your income as well. So IRMA is your income-related monthly adjusted amount. So what that means is Medicare and Social Security are going to assess your income over the last 2 years. So there is a 2-year look back for Medicare premiums. So when you hit Medicare age, they are going to look, if you're 65, they're going to look at your income from whenever you were 63 and 64 to assess your Medicare premiums for that year that you turn 65. And then in subsequent years, it's going to fall into the previous 2 years. So it's just going to keep rolling, but it's a 2-year look back. So if you retired at 63 or 64 and now you need to get on Medicare, your premiums for the next 1 or 2 years may be higher than they will be after that 2-year look-back period is over and you no longer have earned income to take into consideration for your premiums. However, if you need large distributions from any kind of retirement account that is not Roth, those are also going to be taxed as ordinary income and they are treated as earned income. So distributions from your IRAs are going to count towards your income, and therefore they're going to count towards your IRMA or your Medicare premiums. So that is something to keep in mind as well. And that is something that we want to assess with you and just make sure that you get the money that you need to live on in retirement, but that it's not, number one, to the detriment of your portfolio, and number two, that it's not going to bankrupt you with your premiums for Medicare. So again, just things to consider, and some of your Social Security income also matters for your Medicare premiums as well. So, and that's not going to be a huge part of your retirement income probably, but pensions are going to count, and again, any distributions from an IRA are going to count towards that. So, just something to consider with that. I'm not going to get too much into the different parts of Medicare. If you want to hear more about that, Raquel and I did an episode a while ago about Medicare, so we detail the different parts of Medicare, but Medicare Part A and B are your originals of Medicare, your OGs of Medicare, but they may not cover 100% of the things that you need to cover in retirement. So you might need an extra supplemental plan, a Medicare Advantage plan, something to that effect. And I don't know the ins and outs of all of that, but you just might need some supplemental coverage to make sure that you don't lose the coverage and the doctors that you're used to seeing now. And then I want to talk about another piece. I'm back to your group insurance coverages. One of the things I didn't talk about is disability insurance. And this can be a standalone plan. This does not have to be through your employer, though a lot of employers will offer some level of disability insurance coverage. Should something happen to you where you can't work anymore? The reality is that you are more likely to become disabled than you are to pass away. So when we're talking about different types of insurance coverage, it's no matter what you do for a living, it's probably not a bad idea to have some level of disability insurance, because if you are working and you lose your job, even if you're not the sole provider of your household is going to feel that loss of income. So if you are permanently or even just temporarily disabled, you not being able to go to work is going to affect your overall financial plan because it affects your cash flow each month, right? It's going to limit how much you're bringing into the bank, which is going to limit your lifestyle. So if you can't make your mortgage payments because you lost your income, that's a problem. So this is something that I really want to make sure people at least consider. It's not something that's fun to talk about. Passing away and being disabled those are not fun conversations. Nobody wants to think about them becoming incapacitated. They don't want to think about their own mortality. But it's something that needs to be discussed because it's so crucial to that overall picture. I don't want to see you lose income. I don't want to see you pass away, but I want to make sure that in the event that happens, you are covered. So let's talk about, there's two different types of disability insurance that we're going to cover here today. So there is short-term disability and there is long-term disability. Some employers offer one, not the other. Some employers offer both. So it is going to depend on what type of plan your employer offers. If your employer offers one but not the other, perhaps you want to consider getting a standalone policy to help in the event that you become, so if your employer only offers short-term disability, maybe you need a long-term disability plan as well that can help to cover you should you become permanently disabled. So short-term disability that's going to cover you for weeks, maybe months, maybe up to a year. If you don't have maternity leave with your employer, sometimes your employer will offer short-term disability coverage that you'll have to use for your maternity or paternity leave if you have a child. So that can be another, not that makes you disabled, obviously, but that's sometimes the trade-off where your employer doesn't offer maternity or paternity leave specifically, but they do offer short-term disability, so they consider you having a child a disability, more or less, and they will offer that level of coverage where you'll be able to keep your income or a portion of your income. It may not be 100% coverage, but it will replace a portion of your income while you are taking care of your newborn. But let's say you get into a car accident and you have a concussion. You're fine otherwise, but you have a concussion. If you can't work, but you're going to eventually heal and you're going to be able to eventually come back to work, it doesn't leave you permanently disabled, short-term disability will come into play here. So this is, again, where either your employer offers this or maybe you have a standalone plan, but this is under the assumption that you're only going to be not able to work for a short period of time, hence short-term disability, right? So if you're going to be out for a month while you're healing from your concussion and your car accident, that's where short-term disability is going to come into play. Again, it may not replace 100% of your income. You'll have to look at what your employer has offered for you, but it might be 80, 70% of your income. So you're not totally out of income for that time that you're not able to work. You still have a little bit of coverage. And then long-term disability typically kicks in after some sort of waiting period. So if you have short-term disability, that would be the time where you would use that. If the waiting period is long enough where your short-term disability runs out, but now your long-term disability can kick in, now you haven't seen a loss of income for any certain period of time. But long-term disability insurance may not kick in for a year after you are disabled, and typically this is for some kind of permanent disability. So if you are in a work-related accident and you have a loss of a limb, that's a permanent disability right now. You've potentially lost the ability to work. Maybe not entirely, but you might not be able to do your own occupation anymore. You still can work somewhere, but you can't do your own occupation. So that's something else that they consider and they will assess when you're applying for your benefits is, can you go back to work in some capacity, but maybe you just can't do your own job anymore. Maybe if you were a heavy machinery operator and again, you lose a limb, maybe now you can't do that, but you could still sit at a desk and maybe be a manager or do something else where it's maybe a little more white collar. So that would be, if you can't work at all, that's going to be considered any occupation. So if you can't work at all in any capacity, that's going to be where the any occupation definition of long-term disability will come into play. When Social Security, if you apply for Social Security disability, I believe they use the any occupation definition. So they are very strict about what is considered a disability. And if you are able to work in any capacity, they may deny your claim unless you have some kind of qualifying disability that they deem to be eligible for their coverage. Blindness, for example, is one of those things. And there are some other conditions that you can present to Social Security where you'll automatically qualify for those benefits. But just know that if you get denied for coverage for disability for Social Security, it's because you probably can you can work in some capacity. If your employer doesn't offer these, again, it might be worth considering getting a private policy because, again, the likelihood of you becoming disabled is greater than you passing away. And I don't want to discredit life insurance by any means because I think that's an incredible piece of this as well that I'm going to do a whole segment on. But again, disability, while you're working, disability insurance may be more important, or if not the same level of importance as life insurance coverage, because the likelihood of you, again, getting into a car accident and becoming at least partially disabled is probably greater than you passing away in said car accident. So just know that this is an uncomfortable conversation. I know that you don't probably want to think about that, but it's part of the bigger picture. So it's just always something that I want to at least make sure is taken care of. Okay, and then for the last piece of this podcast, let's talk about long-term care insurance, because this is another thing that's going to come into play, especially in retirement. It's not probably if you're in your 30s, 40s and you're working, this is probably not something that's on your radar right this second, but it should be at some point, especially once you retire. Maybe after retirement, disability insurance isn't so much of a need anymore because if you passed away, your spouse would continue on a portion of your Social Security retirement benefit. And if you had pensions with survivor benefits on them, they'll also have that, and they'll inherit all of your assets. So you losing income because you can't work anymore isn't necessarily so big of a deal if you already retired. So disability insurance may not be super necessary once you retire because the loss of income isn't really a factor anymore. But what may come into play as you get older and older is the fact that you may need long-term care. And especially women, I think I mentioned this in my last episode, but women, especially for you, we tend to live longer than men. And so what that means is, and sometimes men aren't the best caretakers, unfortunately. And I don't want to make that blanket statement like men don't think I'm coming for you. This is just the data just shows that women are typically naturally better caretakers than men are, and we tend to live longer. So we have some things working against us, right? So we're going to live longer, so we have to stretch our retirement savings over a longer period of time. And because we have no one caring for us, potentially, maybe we have children that are caring for us, but they might not be able to care for you full time. So if you need full-time care and you have nobody else to care for you in that capacity, that's where long-term care is going to come into the mix. So when we age, the likelihood of needing help, as I said, with your activities of daily living, the things like bathing, dressing yourself, going from your bed to a chair, taking yourself to the bathroom, those types of things start to become more relevant as you get older and older, and you just might start to need help with those things a little bit more. And there is no shame in that, but it's just something to consider that while the front half of your retirement, you might be spending a lot of money on traveling and spending time with your family, towards the back half of your retirement, you might start to see a shift in your expenses from traveling and maybe more fun things towards your medical care. So this is something to really consider as part of your retirement plan. And I say that especially towards the front half of your retirement plan because long-term care insurance can be very, very expensive. Long-term care itself can be very expensive, so I'll talk about that too. But long-term care insurance, the older that you are, the more expensive your premiums are going to be because, again, your insurance company is taking a gamble on you, more or less, and they're going to say they're 70 years old. The likelihood of them needing a nursing home in the next 10 years is higher than somebody who is 50. So if you're considering a long-term care policy of some sort, in your 50s or 60s is the sweet spot for when you might want to consider getting that long-term care policy because the premiums aren't going to be that expensive and you're going to probably qualify for care easier than you would if you're applying when you're 70. Now, long-term care costs, let's go back to that for a second. In Pennsylvania, at least, a nicer nursing home might cost you somewhere between $11,000 to $12,000 a month if you're paying totally out of pocket. So if you have, and sometimes you have enough assets that you could self-fund your long-term care, it's just that you are taking away from the next generation possibly, that you're eating into your legacy. But if that's not necessarily a concern and you have the assets to do it, we may recommend self-funding long-term care. However, if you're on the borderline where we've evaluated your financial plan and we say, okay, you're getting to the point where based on your retirement spending, we are at the risk of you outliving your money if you need long-term care because of the costs. So we bridge the gap with long-term care insurance. So the types of things that are covered by long-term care insurance is going to be your nursing home stays, assisted living facilities, any in-home care, if you have a home health nurse that's coming to see you every day, but you're still living in your house, or things called adult daycare, things like that are all going to be covered by long-term care insurance. Now, I just want to mention that typically Medicare does not cover things like that. So that's, again, where we're going to need to have the conversation of, do you need additional coverage outside of Medicare to help with those potential costs? Now, one of the limitations with traditional long-term care insurance is the fact that if you never need it, you paid your premiums forever and you never used the benefit. So it kind of was a waste, right? But there are a lot of life insurance policies that come with long-term care riders on them, or just like an extra benefit that would help you pay for long-term care. However, if you didn't need it, you still have a death benefit on your life insurance policy, on that portion of it, that your family is still going to benefit from that policy. So it's not like your premiums were going towards nothing. They're going towards a death benefit on a life insurance policy if you don't need the long-term care piece of that policy. Now, if you do need the long-term care piece of that policy, it's going to start eating into the death benefit probably, to where maybe your family doesn't get any or gets a smaller death benefit from that policy, but you used it for its intended purpose, which was long-term care. But having that extra benefit where you get, or your family gets, a death benefit off of your life insurance policy if you don't need the long-term care benefit can be the best of both worlds. So that can be something to explore. Now, I said Medicare does not cover nursing home stays, but Medicaid will. So I think that's an important piece of the conversation too, to distinguish what is the difference between Medicare and Medicaid. So Medicare is your health insurance for over age 65. Medicaid is the government-funded program. I think it's funded mostly by the states, that helps people who are lower income get health insurance, get long-term care insurance, or not long-term care insurance, long-term care coverage. But if you are in a Medicaid facility where you've exhausted all of your other assets, so Medicaid's they're gonna take your assets. If you have over a certain dollar amount of assets, they're gonna take your assets away until you have below their threshold, which is not very high. It's like $2,000 of personal assets that you can have. Now, you can have a car, I believe, and I think you might be able to keep some piece of your house, but most of your other assets they're going to take. So if that happens, they're going to use all your assets first, and then the Medicaid benefit is going to kick in. But because it's a government-funded program, Medicaid facilities are not the greatest. And so that is typically not something that I like to see happen to somebody, is that they have to go into a Medicaid facility. I want to see you have a nice long-term care policy that helps to get you in a nicer facility than a Medicaid facility would provide for you. Now, absolute worst case scenario, if you need Medicaid, it's great that it's there, and I want those people who need it to be able to use it. But if we can properly plan for your long-term care and you don't need to go into a Medicaid facility, that's what we would prefer. We would prefer for you to be in a nicer facility. But that's just something else to keep in mind. Now, there are techniques, and we may have mentioned this whenever I did my episode with Dan Carr, but there are planning techniques that you can use with your estate to help with Medicaid planning. So if you want to avoid a long-term care policy and you say, I don't really care, I'm fine with a Medicaid facility, but I don't want them to take all my assets. There are certain trusts you can put in place that will shelter those assets from being taken by Medicaid. So that is another piece of your estate plan that's worth exploring with an estate planning attorney to figure out what is the best case for me specifically, if I am concerned about the fact that Medicaid may be applicable to my situation. But the bottom line with long-term care insurance is that this is about protecting your independence, your family, and most importantly, your finances. It gives you the choice for how and where you receive care, and it helps ensure that your retirement savings are not wiped out by an unexpected health event. So that was a lot to take in. And again, I want to do a part 2 because there are some other things that I did not cover in this episode, especially life insurance. I want to talk about life insurance, but that needs its own segment. So I'm going to cut this off here. So tune in for part 2 if you want to learn more about different types of insurance coverages and how they affect your overall plan. You can follow us on all social media platforms. It is Watch Your Assets, and we will see you in part 2.